everyone, welcome to Retire with Style. I'm Bob French. I've fully taken over this show at this point. I've got my guests, Wade and Alex, here with me today. So say hi, everyone.
Hi, everyone.
Hi, everyone.
There we go. That's right. But today we wanted to get into some of the more interesting things around kind of the different types of analysis out there. So, previously we've talked about how the markets work, or kind of what the markets are, I should say. We talked about some stuff that very, very clearly does not work, technical analysis. So if you don't like that, I guess, well, sorry, it doesn't work. But now we're going to dive in and start talking about something that works in a way that the people doing it don't want it to work. So we're going to start talking about fundamental analysis.
Hey, Wade. Sorry, Bob. Did you notice something here today? This is Bob's sort of intro. We gave him the shot, right? What have you noticed? Let's review this real quick.
Yeah, let's
yes, please write your reviews on Apple, et cetera, et cetera. It is what it is.
No 5 minutes.
Wait, what did you notice?
Talk.
Yeah.
Very erudite, very straightforward. Here's what we're going to talk about.
That's right.
None of the chit chat. Let's get to it.
This is the straight 5-paragraph essay type of show. So
this is Bob's tight 5. Although Bob, you forgot to mention that you have not seen The Godfather.
I have not.
From the previous episode.
And to be clear, it's still purely out of spite. So
okay, well, I'll just my last one before we get into the down and dirty here. So you have 2 girls.
I do.
Wade, you have a beautiful girl as well, correct?
I do. Yes.
Okay, so I have all boys. So there it is. But this is I want to tackle the challenge you on the it's before my time. I couldn't see the movie or whatever, right? What quote? Well, what song is 16 going on 17 from? What song is that? I am
when it comes to these 80s
going
movies,
on 17.
I watched them as a kid. I don't remember them.
Sound of Music, Bob. Wait, no, that's 1965.
Yeah, that's the 1960s. Yeah.
Sound of Music. You got it, Bob. I thought for sure you wouldn't.
So, Alex, I haven't told you this story yet, but this past weekend I took my older daughter to the bookstore, and she saw the novel of The Godfather, and she asked me about that. Hey, isn't that this famous movie? And I had to explain to her, yeah, it absolutely is. It's supposed to be like the best movie ever made. I have never seen it, and I will never see that because Alex really cares that I watched that. So obviously it's never going to happen. So
wait, what I want to know is why am I living in Bob's head rent free?
Hey, Bob, I saw it is streaming on Peacock right now. If you have that
But
I do want to point out, Wade was talking about how efficient and, straight to the point we are. Alex has still gotten in his couple minutes of chit chat on the front end somehow. So
no, I'm trying to humanize you, Bob. I'm trying to humanize you.
Yeah, I think it's more Alex's bad influence on the show. But
well, hey, so it goes. But no, honestly, you have seen The Sound of Music.
I have seen The Sound of Music, yes.
Wade.
Oh yeah, I've seen it, but I was probably 8 years old, and I don't remember it.
Oh, that's the last time you haven't seen it with your daughter?
No, I don't think my daughters have seen it either.
Really?
Yeah.
Oh wow! I was referencing it, thinking that you've okay.
No, it was definitely
you should check it out.
Something from
you got to
my
show that one
child,
to them. You got to show that one to them. Okay. It's a great movie. All right. Enough. Fundamental analysis, action.
Yeah. So I think a good place to start is, I mentioned we've done a couple episodes up to this point, but one thing looking back that I really want to make sure we touch on is, something actually pretty fundamental to think how we think about the value of a security. We're always talking about like stock price or bond price, but stock price is easier to talk about. we're talking about as if it's this single thing. And, one of the things I really want to drive home is that there's this idea, or there's markets need to clear. Every share of Facebook is owned by someone, or excuse me, every share of Meta is owned by someone. There's no wild shares of Meta roaming lower Manhattan. Every share is owned. And the market needs to find the price where that happens. The market needs to find that price where someone is willing to own every share. Now, that's not to say that the prices are perfect, but it's to say that, yeah, they're pretty good. And, price moves based on that new information, but every share is owned. And that's a really, really crucial point. That bid and ask, the price that someone's willing to buy or sell the security at, they need to converge. They need to find that level. And I think that's a really, really crucial point, especially as we start talking about kind of fundamental analysis, which is when someone's going to go in. Oh, I'm sorry, Alex, go ahead.
Well, with that statement, every share needs to be owned. And so is it fair to say if you already own the share, right, mm-hmm. and you refuse to sell it at the bid, then you're still owning it. You think the price is different. You're kind of setting the price, anyways. At that point.
If I own Facebook, and someone's willing to pay me $90, but I think it's really worth $100, I'm still going to own that share. I'm not willing to take that $90. So that's still cool. If I'm someone who's looking to buy Facebook, or if I think that, Facebook is worth $90, but someone's willing to sell it to me at $100, I'm not going to buy that. Well, what the market's trying to do is find the balance where, that's about even, where where all of those shares are owned by someone who is happy with the price that they're holding that security at.
Yeah, and if someone's
a PhD
happy with
in economics, this is supply and demand.
Yeah, this is the point where the lines cross.
Yes, the quantity supplied has to be equal to the quantity demanded, and the price adjusts to the point where the quantity supplied, the people selling at that particular price, matches the people willing to buy at that price, and then that's the equilibrium, and that fluctuates on a daily basis.
Yes.
Random news hits the market.
That's a much, much more eloquent way of describing that. So
Wade, then, based on last week's podcast on technical analysis, this is you sort of saying technical analysis works because the first tenet was supply and demand, or?
Yeah, that was the first tenet, wasn't it? I think what we determined was the first three tenets make a lot of sense, and maybe that leads you into a false sense of security, because then the fourth tenet took you in a completely different direction of now you can suddenly predict what's going to happen in the future based on past fluctuations.
Yep.
Perfect.
So, I wanted to call that out because with fundamental analysis, this is the one with all the accounting stuff. As we talked about last time, technical analysis is all the pretty charts, and you don't need to worry about the hard accounting stuff. Fundamental analysis is the hard accounting stuff with all of the ugly spreadsheets, where you go in and either for an individual stock, an asset class, an index, the market as a whole, you try and figure out, okay, how much should it be worth? How much, I'm going to go out and predict all of Amazon's cash flows for the next 30 years. And, the stock price is when you really come down to it, thinking about it from the dividend discount model, the stock price of any stock is the discounted value of all of its future dividends, how much money you're going to get out of it. Well, I'm going to model that out. I'm going to model all this stuff out and come up with the price that I think Amazon is truly worth. There's a lot going into that statement, but that's the basic idea. You try and model out a company or the market or whatever it happens to be, and figure out, here's the correct value. And, if the market is saying it's worth more than that, well, I'm going to sell that stock. If I can get a discount on that, if I think Amazon's worth, and I have no clue what the Amazon stock price is right now, if I think Amazon is worth $120 a share and, it's trading at 100, well, shoot, I'm going to go in and buy up as much Amazon as I possibly can because I'm getting a discount on that. And I think the market will be coming up to meet, what I think Amazon is worth. There's a whole lot of assumptions in there, which we'll talk about in a little bit. But one of the really interesting things here is that I think fundamental analysis is a lot more interesting than technical analysis. We haven't been shy about our opinion on technical analysis, but fundamental analysis actually is doing something really, really important in the market. It actually does work in a certain way. There's a lot of value in what fundamental analysis is doing. The problem is, what they're really doing is they're offering a service to the market as a whole. They're not necessarily the one, they are not the ones reaping the value of their work. It's the market as a whole. It's all of us, especially us being kind of passive index type investors. We're piggybacking off of all of the work that they're doing, getting those prices right. They're effectively the altruists of the market, which is a really weird thing to think about. All those people at Goldman and on Wall Street, those are altruists. They're doing us a favor. They're doing all of our work for free.
Wait, did you catch that?
The altruism of the Wall Street.
That's obviously what everyone
word of the week. Word of the week.
Greedy.
No. Yeah. No, but it's a very, very, very good point, Bob. When you say that, and I want to make sure people know that they're not benefiting consumers because I can read their research reports and that I'll buy when they at that price, right, or that. No, that's not what he means, Bob. In case you were thinking that they're providing some sort of research that everyone can piggyback off of. No, what he's speaking about it from a price discovery perspective. They're kind of fighting each other to figure out the right price. They're trying to set the price and that allows consumers to just effectively be price takers and just accept the price as is, because these guys have thought about it enough that it's kind of becomes a best estimate.
Exactly. It's we're able to sit back and just kind of let them do all the hard work of doing all of this modeling and figuring out where should that price converge to. Where should that equilibrium price on Amazon or Cisco or GE or, pick your stock, where should that be? And, they actually do a relatively good job of it, actually, which is what allows index funds and, passive investing as a whole to work as well as it did. If there were this actually gets back to that idea of, when is there too much indexing? That's actually possible. If everyone in the world was a passive investor, it wouldn't work because there's no price discovery mechanism at that point. There's no way for prices to move to the correct level. Now, the problem is that we essentially have an overabundance of fundamental analysts. We have so many people trying to do this and trying to beat each other. The market is the marginal value of that last person doing fundamental analysis is negative. They're not adding value. They're actually subtracting value at that point from themselves. So, but that I want to be very clear here. The market needs fundamental analysis to work. It's just you as an individual, you don't need to pay for it.
Yeah, the irony of ironies here is that if you're an active manager charging somebody, I don't know, whatever it is, 1.25 or whatnot, to invest with them. And if you're a passive investor, that's, complete point of separation from that person. The passive investor is actually benefiting more from that active manager than the actual investor into one of his or her funds. That's effectively what Bob is saying, because let them duke it out, and you could make and we're not getting into it right now, but if you look at the results consistently from active managers, they underperform. So there is no benefit, but in aggregate, having them duke it out, it kind of benefits us. And what Bob is saying from the vantage point that, yes, if everyone was a passive investor, there would be capital would be inefficiently allocated because no one is discovering in the discovery piece. But we can comfortably say that the markets are efficiently inefficient, for a while. What that number is, I don't know, Bob, but what that line of demarcation is doesn't matter, because it'll like flip back very fast.
Exactly. That's one of the beauties of the financial markets. They're self-correcting mechanisms. If too many people start indexing, if too many people just start being passive, well, those fundamental analysts, they're going to start outperforming. They're actually going to be, there's going to be few enough of them doing it that they're going to be providing actual value, which means people are going to see those higher returns and flood back over there to try and capture those returns. And it's just going to be that cycle back and forth. Now, the problem, like I said, is we are so far past that point, with so many people trying to predict what price levels should be, trying to beat the market, that we're a little more than a little out of whack, even with kind of the rise of passive and index type investing. But that fundamentally is what's going on here.
And so there is an element of free riding to some extent with passive investors. But at the end of the day, like when I first started learning about investing, I kind of realized that my comparative advantage in the world is not going to be to pick the individual companies to invest in. I'm not good with the balance sheets and being a fundamental analyst, but if I can not spend my time trying to pick individual companies, that just frees up time to do other things. And that's where, like, anyone who's been part of retirement researcher knows we're not telling which individual companies to invest in. There's all these other aspects of financial planning and tax planning and everything that goes alongside that if you can focus your efforts on other aspects of financial planning, and to some extent piggyback off the fact that we do need some people doing that fundamental analysis, and they are being compensated for it because they are charging fees for the work that they do. And that's where, net of those fees, it can be hard for an investor to benefit from investing directly in those active managers. But that at the end of the day, there is some sort of balance there. And like you're saying, we don't need everyone in the world. We need some people doing fundamental analysis, but as an individual yourself, whether or not you want to engage in that fundamental analysis partly depends on, do you enjoy it? Is it a hobby for you? You may recognize at the end of the day, you might not have a better investing outcome, but if you feel better doing the fundamental analysis yourself, there's no problem with it. It's not like with technical analysis, we'd say you're wasting your time ultimately, but with fundamental analysis, it is useful and important. And if you enjoy it, more power to you. It's just not everyone in the world needs to be doing fundamental analysis.
Well, but wait, you can do it, but I don't think you're saying the second part of that sentence, which is you most likely will not be successful at it.
Yeah, and you may not have a better investing outcome, but you're not necessarily creating harm in the same manner that you would be if you devoted all your efforts to the technical analysis. You may still underperform the market just because at the margin, you may not be getting a better outcome from your fundamental analysis, but at least it is providing a socially useful.
Yeah, no, I think just to be clear, as an individual, if you're doing fundamental analysis, again, thank you. The value you're providing is to the market as a whole rather than yourself. but there are so many other people out there doing fundamental analysis that the marginal value you should be expecting to receive, again, is 0 to negative. And that's even before considering the time that you're spending. So as Wade said, if you just think it's fun, and knowing some people who listen to this, I'm sure there are some people who, they have fun with spreadsheet hour every night. They are fun, but it just to be clear here, the marginal value on that next fundamental analysis, it's nothing. It's just not there.
I think you guys are hedging here a little bit. I would say it like, if you think it's fun, become a bookkeeper or something like that.
That probably would be a better.
No, seriously.
Time.
No, because we use this for our own company, like McLean and Retirement Researcher, and yes, we do figure out like net present values and things like that, right?
Yeah.
But as an investor, I think you should treat it like, picking stocks or whatever. And this is where we made the supermarket comment a while ago. And yes, it's not a 100% solid analogy, but like when you go buy milk, I don't buy milk and I look at the milk carton and say, oh, it's whatever, $2.50. Yes. I just buy it. Assuming there's no budget constraints, you just buy whatever you need and you move on with your day. You don't worry about, ooh, what was the price of chips today? That kind of thing. This is like, I'm getting away from budgeting. I'm having the conversation of just the dynamic of when you go to the store, you accept the price for what it is. You don't necessarily
you don't
start engaging.
The grocery
yeah,
store.
Exactly. That's exactly correct. And to me, that's, I can hedge, but I can be the bad guy, which is become a bookkeeper. At least get paid for it,
Yeah.
by somebody, and then, or take up Sudoku or whatever. And then think about buying stocks. Like when you go to the grocery store, you accept the price for what they are,
Yeah.
and I was going to get into that whole, remember Sinkfeld,
Mm-hmm.
Bob, when he would get into, fundamental analyst and capitalist, and, he would draw upon Hayek in terms of, look, the capitalism, right? Assets flow efficiently, and you accept that because there's a good allocation of capital. The only people that don't feel that are people that try to really engineer economies, if you will.
That's
because
right.
capital is not efficiently allocated, right?
Yeah.
And so that would mean that there's mispricings everywhere, because as an aggregate, as a whole, we've mispriced securities, right? Which is an inefficient use of capital, if you will. And, the story, Sinkfeld goes on and tells his thing. I'm not going to do it as good as him or anything along those lines. But effectively, when you get right down to it, the only folks that consistently believe that assets are misallocated and things aren't priced the way they are people that construct economies, that really engineer them, and fundamental analysts to a large extent. And
Alex, just to be clear here, you're saying fundamental analysts are communists. Just to be very clear about what we're saying.
No. But why don't you get to the punchline?
Effectively, this is the first time I've ever been accused of being insufficiently harsh on active management. But Alex is absolutely right here that it's, if you think you can outpredict the market or come up with a better price or a more true price for pick a company, that means that you are saying you're smarter than the aggregate of everyone out there, of all of the other people trying to figure this thing out. And maybe that's true, but you got to have some pretty strong evidence of that. But I think what might be good here is to actually walk through an example of what fundamental analysts are actually doing here, because we're talking very, very high level, fundamental philosophies of how economics works here, apparently, when they're bringing out Hayek and all this type of stuff.
Well, no, but it goes to the whole technical analysis, like silliness, where what's the anchor here? What's the anchor to this?
Absolutely. But okay, so let's pick Amazon. I actually just took a look at the price. It's call it. We're recording this a little while ago, so hopefully nothing super major has happened. But it's trading around $100. Market cap is around $1 trillion. Now, let's say I go through, I run the numbers. So I go out, I forecast all their cash flows, I look at all the business lines. So, Amazon.com, the biggest store in the world, AWS, all of the web services stuff. I don't know, all of the other ancillary businesses that they run. They've got their fingers in like everything. So I know there's no way of me doing all this.
Their ad business is going crazy. Just FYI.
So I try and predict all of the cash flows. Now, first off, let's recognize just how big of a challenge just that in and of itself is. When we look at the cash flows of our sister company, McLean, a financial advisor, one of the simplest kind of businesses to kind of model out. It's really friggin' hard. It's really hard to kind of figure that out. Now, expand that out to like one of the largest companies and most complex companies in the world. I'm trying to do this out through time. But I do it. I come up with the numbers I think is right. And I think the company is worth $900 billion. I think the market is overpricing Amazon. I think it's worth less than what the market is charging for. So instead of $100 per share, I think it should be, call it $90 a share. Well, I'm going to go out and try, and if I own Amazon, I don't want to be holding that at $100 a share. I want to sell that as fast as I can. I want to capture that $10 per share of value, or as close to it as I possibly can. So I'm going to go out in the market and just dump all of the shares that I own. We talked about how the market is a self-correcting mechanism with regards to the number of fundamental analysts. It's also self-correcting in terms of price discovery. That's going to tell the market the price should be lower. And, me personally, if I was to go sell however much Amazon I happen to own, I have no clue. That's not a big signal. I'm not moving the market a lot, but it does contribute to the information out there. It's saying that I think that it's worth less. And enough signals like that, that's going to move that equilibrium point that Wade was talking about there. That's going to pull it down. If, on the other hand, I thought it was worth, $1.1 trillion, I thought the share price should be $110. Well, I'm going to go out there and buy as much Amazon as I possibly can. And that's going to push the price up. And, theoretically, if I had effectively unlimited money, I'd keep doing that until it got to the price that I think Amazon is worth. That's the basics. That's what's going on here. But
Bob,
yeah,
is it fair to say, I'd like to add one caveat, because I'm just trying to think when we say the average investor, and there could be a listener, well, I'm sure they are, right, that they're saying to themselves, well, the average IQ is 100. I know that I'm a good 1.5 standard deviation above that, because whatever I'm in Mensa or whatever their like cutoff is, right? So I'm at 130, 2 standard deviations, just to there you go. You're 2 standard deviations over. So I am going to play in this game because I do know more than the average market participant. I the flaw there to me is like everyone's vote isn't equally weighted, et cetera, and it just depends on a couple of discoveries, to be done to sort of set that. But I mean, is there something for you to add on that? How you would counter that person saying, "No, but I'm smarter than the average market participant"?
Yeah, absolutely. That it's not think of it as the weighted average participant, and even more than that, the dollar weighted average participant. So, you going in, let's say you got $10 million to play with. So you're doing real well for yourself. You got $10 million to play with. that's not even a drop in the bucket. We're talking about, a truly massive system, full of people who are also really, really smart, trying to figure this stuff out. You're not competing against retail investors. You're not competing against financial advisors. You're not competing against us. You're competing against the big institutional players. Those are the people who are truly driving the market. Now, you say what you will there about a lot of those people. Apparently, they're altruists, as we said, but they're also incredibly smart themselves. They have access to incredible amounts of information and incredible tools to process that information. Even more importantly, we all have access to largely the same information set. We got access to all the annual reports. We can go buy Bloomberg. We got all this stuff we can get to, but we don't have the tools to process it as efficiently, as fast as some of these other kind of more institutional type players in the market. And that's who we're going to be competing against. But
I would say though that in the previous episode, we said that, there's institutional money, but even in aggregate, that can be dwarfed. I would also, so to add to that, it's an and, not a but. I would say because of the market dynamics and how the price discovery works, there, and this is, now I'm going to quote Dan Wheeler, who we talked about in the last episode, rest in peace. Effectively, they're fishing in an empty lake. The dynamics are such that you're playing a game you really can't win because everyone is participating in it in a certain manner. Bob?
Yeah, no, exactly.
It's nothing to do with intelligence. There's
right.
There's a lot of money in money, so there's a lot of smart people there, but that's not the case. Go on, Wade.
And it's not you're not competing against the average investor. You're competing against the aggregate beliefs of all investors. And you have to somehow have an insight that all other investors in aggregate did not have.
100%. I just wanted to address the average investor. No, but the average investor, hell, the average IQ is 100. So you take a random investor. I know I can beat him. That kind of, I just wanted to kind of just put that to rest.
Yeah, no. And I think it's worth kind of also talking about some of the assumptions that you're making in terms of when we're talking about trying to beat the market using fundamental analysis. The first is you're coming up with the correct price, which is a heroic assumption in and of itself, that you can truly value this where everyone else can't. But it's worth pointing out that's useless in and of itself. So the market's trading Amazon at $100, but it really should be at 110. Okay, great. You know something that no one else knows, but unless something changes, that doesn't mean anything. The second assumption is that the market will then realize your genius and come down to the level that you think Amazon should be at. So the market, for this to be at all useful, the market has to agree with you. The aggregate of the market has to agree with you and push Amazon up to $110. That's how you make your money. By buying it down when Amazon is trading at $100 and everyone else agreeing with you and coming up. Now, it's interesting to note that both technical analysis and fundamental analysis are making a pretty big assumption that the market is rational, just with a lag. They're saying the market's going to be rational just on my time scan or time frame. It's going to wait for me to figure this out before it moves to, whatever the new price is supposed to be. That's a little bit egotistical there.
It's like that quote, the future's already here. It's just not evenly distributed. And you're constantly on the front end of that distribution.
Yeah. So, those two assumptions there, that one, you're going to be able to figure this out better than everyone else. Really big in and of itself, but sure, we'll grant that for right now. But you've also got to make the assumption that everyone else or enough other people will come to the same conclusion that you did fast enough for it to matter. Because, obviously all these things are moving around, meaning the true price is going to move around as well. So the market needs to come to that slow enough for you to be the first or one of the first people to come to that conclusion, but fast enough that, it's still meaningful, fast enough that that true price is still useful. You're threading a pretty fine needle there, basically. So it's always worth calling that out.
Yeah, and what we're not mentioning, and it may be beyond the scope of this podcast because we could go on and on, is the assumptions to derive at that price. Because you're just saying in one sentence, you get to a price. Yep. But if you really do it, and this Bob said it very early in the sense of, look, our own companies, McLean, I can't tell you what our earnings are going to be at the end of the year. I really can't. And think about that, right? And then you have Amazon, $1 trillion company that analysts get it down to the penny. That's a game. It's just a game. Out on that game, they're backing into a number. But let's say you're now doing this yourself, and you're gonna, to do this analysis, there's present value calculations that you have to take into account, which assume a discount rate, and the discount rate is based on the risk-free rate, which is, think about the conversations that Wade and I and Bob, to some extent, have had over the last 50 episodes about market assumptions and the flaws in capital market assumptions and the best estimates of capital market assumptions for financial planning. Well, multiply that by 100, if not more, when you're taking Amazon into account. And not only do you have to be right on what the quote-unquote present value is based on all these macroeconomic factors so you take the right discount rate, but then it has to manifest itself before you go bankrupt, before, you're consistently theoretically right, but in practical terms, it's not there.
Yeah. What's the Keynes quote? The market can stay irrational longer than you can stay solvent.
Yeah, exactly. Liquid. Yeah. Who was a terrible investor, by the way. No, not Keynes. I'm sorry. I was thinking of,
it was Fisher.
The Apple guy. You're thinking of the East India Company stuff.
Yeah, the Apple guy.
Oh my God.
Jesus. Oh my goodness. They're going to kick us off the podcast. Someone Google this.
This is kind of pathetic here.
Isaac. Wait. Hang on. This is embarrassing.
This is bad.
Isaac Newton.
Thank you.
Smartest guy ever, actually, right? Him and Da Vinci. Isaac Newton, remember, but that was more behavioral finance thing. Yep. Who lost everything, I think, in the East India thing.
I don't know if it was everything, but yeah, he got caught up in that whole bubble, and he got wiped pretty hard.
Yeah, but going back to, it's not a matter of intelligence. The full circle here is, it's not a matter of intelligence. You're not smarter than him. No one is.
Yeah, no, absolutely. That's a really great example. I mean, it's obviously wasn't quite developed, and actually, this is a good entree. Well, first off, I'll also call out, getting at that complexity for calculating a lot of this stuff. I actually have a workshop in the Academy, the Retirement Researcher Academy, talking about a lot of these investment statistics, and we get into calculating NPV and all of these fun things, or at least I think they're fun. But if you really want to dive into that, that's something you can take a look at there. But I wanted to talk about, there's a couple different approaches. There's a lot of different approaches, but two kind of big kind of categories of approaches to fundamental analysis. So there's the Graham and Dodd type value investors who are looking for kind of big mispricings at the kind of company level. They talk about value investing. It's very different from kind of the academic value investing, the value premium type of stuff we talk about. And then there are people who are just looking for just straight up mispricings, price arbitrage type of stuff. So let's start with kind of looking at the Graham and Dodd folks first.
And that's Warren Buffett would be the more modern. Just Warren Buffett would be the more modern iteration of
Graham and Dodd are the guys who wrote the book, literally wrote the book on it. But yeah, there's a lot of people who are doing it, and Buffett is probably the most famous kind of, I'm not sure proponent is the right word, since he's out there telling everyone just go buy index funds. But the most famous practitioner, I guess you could say.
Because he wants fewer
So the
fundamental
idea there,
analysts to compete with.
yeah,
He's
exactly.
trying to push that.
Another just easy guy to kind of push over there. But what they're really doing is they're looking at the companies from an intrinsic value. So they're looking at the accounting values and looking at the moats and all of these different types of things. And they are systematically doing the pricing models on all of these companies. These are the people who will have like 5 stocks they're really, really sure about, and that will be their portfolio. And to them, that's a great diversified portfolio because they're really, really confident in their calls about these 5 or 10 companies or whatever small arbitrary type of number I'm going to throw out there. And, they're going to wait for the market to come to them effectively. So what they're
the only
really
caveat I would add, Bob, I would add to this caveat, I think it's important. We're dealing it from value investors that are like spreadsheet warriors right now, but there are a group, and you could throw Buffett in the mix. There are a group of investors that do more than just, find an undervalued security, but then they're actively participating in that company.
Yes.
Even vulture investors and things like that. And I don't think from a spreadsheet valuation standpoint, yes, I agree with you, but I wouldn't put like the vulture guys or the activist or those folks in this mix just yet.
That's fair. Yeah, no, and Buffett actually, he's a good example of those activists. There's a lot of people out there talking about him who, he's not really an investor. He's really just a manager,
businessman.
He goes in and when he buys a stock, he's buying enough of that company that he gets to go in and effectively, he's the CEO or he's the person who gets to make the final call for that company and guide that company into doing whatever it is that he thinks is best. Whereas you or I, if we're doing this, we're probably not going to be able to put ourselves in that position. We're just going to be kind of, I own 0.0005% of this company. The CEO ain't going to be taking our call.
Yeah, but that's all I want. I didn't want to take it too far off because that's another kind of thing, if you will, and we can do a private equity thing at some point. But it's really more, I just wanted to get the sense because I'm thinking people are listening and there's more to Buffett than just, identifying a lower price and that's it. There's more to Carl Icahn. There's more to, I don't know. There's always a new group of people.
Almost any of them that you can name are probably more in that type of category, unless you're really diving deep. But yeah, no, absolutely. That's a really, really important point that those people are not price takers. They're people who are actually influencing these companies. But again, getting back to kind of the Graham and Dodd value investor, they're people who are trying to match up that intrinsic value or find the difference in that intrinsic value, I should say, from what the market's doing and then waiting for the market to come to them. It's a very, very systematic type of approach that, again, really adds a lot to the market as a whole, even if it's not as much them. The other type are people who are looking for more the arbitrage type of approaches. They're looking for kind of those quick hits in terms of differences. They'll do kind of big, broad scope analysis and look for those stocks that are just slightly different, wait for the quick turnover, and kind of go at it from that angle. So it's really a question of kind of slightly longer term with kind of that value investing type of framework versus the arbitrage quicker type of turnover type of stuff there. So that's a really important distinction. But what you want to be thinking about is what type of information are these people really bringing to bear? We've talked about how valuable it is because they're bringing in all this information. They're doing this price discovery for us. What does that what are they actually doing? And a lot of people kind of think it's just they're sitting down with a 5-foot pile of annual reports and just running the numbers. And yeah, okay, they do that, but that's only part of the analysis. What they're really doing is they're bringing in all of the available information. So they're looking at those annual reports, they're looking at balance sheets, they're looking at income statements, but they're also incorporating, what do you think the market's going to look like? How's the economy going to change over the next year, 5 years, 10 years, 30 years? How are people going to react to that? How are people going to react to that reaction? All the way down the line. It's kind of the Iocane problem here. I know that you know that I know that you know, and having to model all of that out and incorporate that into your model. It's hard. It's a lot of uncertainty. And at a certain point, there's a ton of information there. But at a certain point, you kind of making a guess a little bit.
Yeah, and look, we're not bringing up individual data right now on investors because you could be asking yourself while listening to this. Yeah, but there's some people that are successful.
We'll talk about that next
week. yeah, we'll get to it because it's almost like sport, frankly. But we'll get to it. We're laying down, as you picked up from this podcast, we're just laying down the theoretical underpinning because if you understand it at this level and it makes sense, it's kind of good enough, to a certain extent, because the numbers will, you'll see how they follow. If it doesn't ever make sense and we show you numbers, then it's not as strong.
Yeah, the numbers are, we could go there, but if you don't get the basic argument, or if you don't agree with us on the basic argument, we're not going to agree on what the numbers mean.
Yeah, exactly. 100%. I can't tell you how many times we can show you numbers over and over about look at the performance, this and that, but you'll still do your but kind of thing. So this is our attempt.
Yeah. And so, I mean, that's kind of the big thing here, that the fundamental analysts are the ones who make the market operate efficiently. They're the ones who allow the efficient market hypothesis to actually work, ironically, by trying to break the efficient market hypothesis and beat the market. But again, this gets back to the financial markets being just incredibly powerful self-correcting machinery, in that, when someone outperforms, well, everyone does that. And that brings it back down into line.
Let me introduce something here, because I gotta again assume that some people are thinking this. We're throwing the word market efficiency around now. I think it's the first time I've heard.
I think it might be the first
today,
time. We need to...
Right, and so it's an interesting concept. But let me actually bring Wade in, since he's the trained economist. I don't even play one on a podcast. I just fool around, right? Wade, what market efficiency, how would you say it from a textbook perspective?
It's the idea that's really been the underpinning of what we've been talking about, that everyone's trying to outperform the market. Now, setting the passive investors aside who are free riding off of the others, but everyone's trying to outperform the market. And so the given market price incorporates all the available information, that if enough people thought the price was undervalued, they'd buy it today, and that would push the price up today. If enough people thought the price was overvalued, they'd sell it today, and that would push down the price today. And so the price today in the efficient market hypothesis is just the collective wisdom of everyone in the market trying to guess what the market's going to do, leading to an equilibrium between that supply and demand, that the current price we see is the price that incorporates all available information, such that will the price go up or down tomorrow is going to depend purely on the news that comes in, that's going to be random with respect to whatever people were expecting. That if like a great example is a company could have record earnings and the price would still go down because the market expectation was that the earnings would have been even higher. So whatever news comes is ultimately random with respect to nobody in the market knew what that was going to be. And that's how you see the price changes. And so you can't really predict future price movements because the efficient market idea is all available information is incorporated into the current price of the security.
Okay. Then I would ask, I'm going to play a little bit of a devil's advocate here because this is where people kind of like start saying, aha, I got you, that kind of thing. All right, Bob. So, I thought, Wade, just to add to that, I thought you were going to go into the perfect form, semi-strong form, that kind of CFA definitional thing. But okay. I want to make the point clear. This does not mean prices are perfectly priced at all. Let's get that out of the way because this is where people can say, come on, don't give me that. That prices are priced perfectly. Look at GameStop. We referred to it the other day, right? This does not mean that prices, or it does not need to happen, that prices are perfectly priced. So, Bob, what would you say if someone said, yeah, but look, Schiller just won the Nobel Prize? With FAMA even, of all things, right? Talking about how prices aren't rational. So I'm bringing now the concept of rational. Prices aren't rational. And so we can catch those moments of irrationality, which, the volatility on the markets are such that prices aren't perfectly priced. It can't
a couple
be.
Things.
Why don't you say a little thing about that?
The Nobel Prize Committee, they hedged real hard on that prize. They gave it to a couple people basically for saying every part of finance. That was basically the creation of finance Nobel Prize. So FAMA was
it was a technical analysis. It was a technical analysis
that's
conclusion.
Right. Yeah,
they just could go either way.
Fire those guys out for some reason. But so a couple things there. One, I would also point out, Schiller, Thaler, all of these guys saying, hey, there are problems in the market. Their end suggestion for 99% of investors, go buy an index. Just go buy the market. Don't worry about it. This doesn't have that much of an effect end of the day for truly long-term investors. So there's absolutely that piece there in that, what do you do with that? Not a huge amount, or at least you can ignore that over very long-term time periods. The other thing I'll call out is the market is, everyone kind of recognizes the market's going to do weird stuff. That's just going to happen because there are people involved. We're not perfectly rational, all that type of stuff. But getting back to your main point that prices aren't perfect, that's a really, really important idea. That's often kind of the soundbite that you hear about the efficient market. It says the market's perfect. It's not. Even FAMA will come out and say, yeah, prices aren't perfect. The catch is there's a but there. That but is that we don't know. We know prices are wrong, but we don't know if they're wrong because they're too high or they're too low. And at that point, when we can say they're wrong, but we don't know which direction they're wrong, we kind of just have to accept them. We kind of just have to start from where they are now and say, okay, that's my best guess. And that's all anyone's ever really going to say about prices. These are the best guess given all of the available information. And all, Wade, you can probably hear Wade stressing that all in his definition. That all is all. That is all encompassing. Everything you can possibly imagine gets funneled into those prices. The Super Bowl score is somewhere in there. Probably not moving it that much, but it's in there. And everything else as well.
The only thing I would say to that, and I think we can do this when we talk about like market timing, because I want to point out, I'm going off of one phrase that you said, that we don't know if it's overvalued or undervalued. I think at the securities level, I subscribe to that. But could you say at the .com boom, during the boom, hey, there's a bubble here. So if anything, it's overpriced, not underpriced. I'm not arguing. I'm just, I don't want to discuss it even right now. We'll do this when we get to market timing because we're at the
there's a conversation
mark
to be
right
had
now.
there that will
exactly. And we'll spare everyone until we get
Until
to
next week.
But I will say this from my definition of market efficiency. If you integrate what Wade said and you integrate what Bob said, where I land is effectively, I don't care if markets are overpriced or underpriced. The best estimate is what we see. And you're most efficient just taking it, like going back to the milk example, right? But more importantly, I truly feel it's efficient in this sense. Wade and Bob can't Wade and Bob, if Wade, myself, and Bob have access to the same information that's available, I am not going to consistently, and I'm using the word specifically, I am not going to consistently outperform Bob. I am not going to consistently outperform Wade, and vice versa. If we have access to the same information, the markets are efficiently priced in the sense that we're not going to outperform each other, based on some extra insight, based on some extra neurons that I have popping because my IQ is 5 points greater or less than either one of them. No, it doesn't happen like that. And that's where I land on this market efficiency in terms of, I'm not, if we have access to the same information, I'm not going to outperform persistently anyone, because in aggregate, it's just how it is.
Yeah. I mean, that's at the end of the day, that's really what it comes down to. What should you be doing with your own money? Well, I mean, unless you are basically, if you are in a position to be able to consistently outperform the market, you ain't listening to this podcast. You're on your private island somewhere with your trillions of dollars, because that is incredibly valuable. It's also incredibly rare. And we'll talk about that in a couple of weeks about how we know we can make that statement. But that's exactly right. What do you do with your money? Well, just kind of take the market, and that's your best bet.
Good way to wrap it up.
Yeah.
Yep.
Yeah.
All right, everyone.
Okay. Yeah, this is going to be a lengthy episode, but thanks everyone for joining, and we'll catch you next week as we continue. It is the next week's episode will be on market timing, right?
Yep.
So, look forward.
Perfect timing. No pun intended. All right. Take care, everyone.